We finally found out the stock Buffett has been hiding for 3 quarters straight. Buffett bought 6.7 billion worth of a Swiss insurance company called Chubb. We're also going to take a look at another development from Berkshire Hathaway's 13F filing. They trimmed their largest holding, Apple, by over 10%. Starting with this article here, we're going to look at the main headlines of the story, right? So Berkshire Hathaway bought 26 million shares of this insurance company Chubb, which is worth about 6.7 billion, which came to their, I think it was their 9th biggest holding at the end of March. Now, they did hide this for 3 quarters straight from a special file from the SEC saying that they could hide it so the price wouldn't go up. In other words, so Buffett could buy shares at a good price without it going up, right? Because it's gone up since it's been bought, right? So if we pop over to Berkshire Hathaway's most recent 13F filing, obviously we can see up the top here, they're still their largest holding is Apple, which we're going to talk about in a minute. But if we come down here to CB, which is the ticker for Chubb, we can actually see what's happening here. So on CB, they, as we were saying earlier, they bought 26 million shares to the value of almost 6.7 billion, right? So this is a brand new holding for Warren Buffett, and it's an insurance company, and we're going to look at the fundamentals of this afterwards as well. One notable thing also is Apple, right? So you can see Apple is their largest holding. It's almost 135 billion, and it's now 40%. It used to be 50%. So they trimmed this by almost 12%. And we're going to take a look at a kind of a video towards the end that kind of explains this. I think what's going on here is essentially it's their largest holding, right? It's not good to be in one company for like 50% of your portfolio, and Warren Buffett knows this, right? That's why he's trimming it when the value is up now from when he bought the shares, right? You can see here that he bought, at $40 per share, and the price is way above that now, so they're making a killer profit on that. So let's go over and take a look at Chubb's fundamentals now. Moving over to the fundamentals of Chubb, right? I did want to take a look at this one article on this platform. So again, it says Berkshire Hathaway bought the shares, but the key point is here, it's up 6% since they bought the shares, right? So if people were looking to buy now, it's probably not the best opportunity. It seems it's at all-time highs. I would probably wait it out a bit. So let's go back and actually look at their fundamentals now. So starting with the share price, we can see when Buffett bought the stock, just as we were looking at here, it went from 245 now to 274, right? So it went up about 7-8% since then. So it's at all-time highs now, right? It has been climbing though, so maybe that's why he's looking at this stock. So if we come down here, first off, looking at their key ratios. So their PE is quite low, right? So 12.49 is very good. Their EPS is pretty decent. They have an okay dividend yield at 1.25%. I mean, it's not amazing, right? But at least it'll pay you while you're holding the stocks. They have quite a large revenue as well at almost 50 billion. So if we come in here and look at a few more of these, see if we get this loaded. Coming straight over here to financial strength, right? So looking at their free cash flow. So we have, the guts of 12 billion here, good sign. Their payout ratio is quite low, so we have 15.52%. That's very sustainable for the dividend. Let's come over here and look at their profit margin. So usually what I look for here is over kind of in the double digits for profit margin. So they're making a good bit of profit, right? So we can see the 5-year average is 15%. That's positive. And we can see the trailing 12 months is 18%, which is very decent. We scroll down here, nothing really else to look at here. Let's look at the growth. So their revenue for over the last 3 years have grown almost 9%. And over 5 years is almost 12%, which is decent. Earnings per share has grown 20% or 21% in the last 3 years, 40% or 41% in the last 5. Let's look at net profit margin. So their margin is growing by almost 9%, and their dividend is growing by 3.3. So that's kind of low, right? But at least it is growing as well. So if we pop back here and we actually start looking at their financials. So let's start at their income statement. Let's close a few of these. Let's go back to 2021. So their net income in 2021 was 8.53 billion, went down in 2022 to 5.25, and is back up above 9.03 billion. So that's a positive sign, right? Let's go to their balance sheet. Let's close these off. So their total, let's look at assets first. So their total assets in 2021 was 200, down by $1 billion in 199 in 2022, and then up massively in 2023. So that could have been another thing that prompted his purchase of this thing. If we're also to look at their assets versus their debt, right, you can see that they have an immense amount of assets versus the debt, which is a very good sign. So their debt is 14 million or almost 15 million, and their assets 230. That means, if they were going bad in the morning, could they sell assets to get rid of that debt? Yes, they could. They could sell it, 10 times, 20 times over. So let's move over to their cash flow. So closing a few of these out. So let's go back to 2021. So let's just look at the net change for the 3 years. So they went down in 2021. They went up 316 in 2022, and they went up $500 million in 2023. So one of the main things to look at here is their cash from operating activities, right? So that's the cash they're producing in their kind of every day, throughout the year, right? So that was 11.15 billion in 2021. It went up to 11.26 in 2022, and it went up to 12.63 in 2023. So I think all around, right, very positive fundamentals. As I already said, it is an insurance company that's based out of Switzerland. I don't think it's, too key to go into like massive amount of what they do, but insurance company for Warren Buffett. He had Geico for many years and made a killing on that. Is an industry that he's very familiar with. And this company, is kind of medium sized, 40,000 people. I think we saw their revenue was 50 and their market cap was almost 112. So, I can't really fault his purchase here. All I'm saying is, the fundamentals are good. The price is really high now at the moment. Maybe it would have been good to buy when he had just announced that. Obviously, woulda, shoulda, coulda. But I think this is a very positive move for him. I would definitely look at investing in this stock. It has good fundamentals. The one thing I would say, though, is return on capital, right? So they, over the last year, if we go back to this time last year, so they're up from 190 to 270. So yeah, that's a pretty good return. What I was going to say is, I wonder are there better opportunities for capital deployment and return than Chubb, right? So let's go over and look at to finish up on that one video about Apple, about where Buffett is talking about why he unloaded 10% of his shares. So this is a CNBC interview, which was their most recent annual meeting. And the first question here is about why they trimmed their 10% of Apple, which is their largest holding, right? Take a listen to this.
Let's start. Just given what you mentioned, there was some news that came out in the 10Q this morning. It shows that Berkshire sold another 115 million shares of Apple in this last quarter. That's Berkshire's largest holding. And I think in that vein, we'll start with a question from Sherman Lamb. He is a 27-year-old Berkshire Hathaway Class B shareholder from Malaysia. And he asks, last year you mentioned Coca-Cola and American Express being Berkshire's two long-duration partial ownership positions, and you spent some time talking about the virtues of both these wonderful businesses in your recent shareholder letter. I noticed that you have excluded Apple from this group of businesses. Have you or your investment manager's views of the economics of Apple's business or its attractiveness as an investment changed since Berkshire first invested in 2016?
So right off the bat, I think a really good question, right? Just straight to the point, why did they go down 10%, one of their largest holdings? So it's a really short answer. I'm just going to fly through this.
No, I would, but we have sold shares. And I would say that at the end of the year, I would think it extremely likely that Apple is the largest common stock holding we have. Now, one interesting thing is that
he kind of goes off topic here now, but essentially what I'm taking from this is, they trimmed because the holding was too large. It's almost 50% of their holding or their total portfolio. And the fact that, towards the end of the year, they might pick some more back up, right? They kind of just wanted to clear up some assets to buy, Chubb or buy something else. So I think he goes on to kind of talk about why he buys stocks and, buying businesses, which is, not really relevant. So I think maybe just before we finish up, it might be good to actually take a look at Apple's fundamentals. I do own some Apple, and I believe I'm up on it at the moment. So if we pop over to my investments, yeah, you can see I'm up 17%. I don't really hold too much of it. If we look at their chart over the last while, yeah, they're kind of ebbing and flowing, right? There hasn't really been massive gains or massive losses, right? It seems to have gone down here for some crazy reason. I'm not really sure why, probably just to do with the stock market in general. But let's look at some of their metrics. Let's come down here. So their P is high enough, right? But being such a large company, I don't think that's a big deal. Their EPS 6.13, obviously one of the largest companies by market cap at 2.91 trillion, and revenue of almost 400 billion, right? They also have a dividend yield of a really bad dividend yield, but you know, that's not really what we're looking for from Apple. We go in here and look at their financial strength. So current ratio, quick ratio, all look good there. That's just, you know, current ratio is their current assets and liabilities. Quick ratio is current assets and liabilities, including the inventory alongside that. Their payout ratio at 15.46% is pretty positive as well. We pop back over here to their margin. Their margin over the last 5 years is 24%, and it has been growing over the last year, 25 and 26. And let's look at their growth as well. So their EPS, or the revenue first, has grown by 11% over the last 5 years, almost 8% the last 3 years. EPS 15% over the last 3. So yeah, looking very positive here. Dividend yield has grown as well, which is surprising enough, you know. Net profit margin also, that grew very small though. That's the one thing I would highlight there. Interesting enough, but I suppose being a mature company, you can't really expect too much. Looking at their fundamentals, so if we start off with their net income back in 2021, so we had 94, almost 95 billion, up to almost 100 billion, down a little bit in 2023, so far 97 billion. So yeah, not too much change really. I wonder if we look at that quarter over quarter. So Q4 2023 was almost 23, Q1 was 33. Yeah, so they're trending in the right direction. If we look at their 2021 here as well, so what I'm looking at here is asset growth. So 351, 352, 350. Yeah, so that's pretty solid. Liabilities is growing 20. Yeah, so the liability grew a lot from 21 to 22, but then went down to 2023 is very positive. And then if we look at the most recent year, 2023, right? Again, looking at their debt versus their assets. So if we close this, so they have that's total assets, they have 352 versus their debt of 122. So, you know, if they went bust in the morning, they have assets of 352 versus 122. So they could pay off their debt 3 times over with assets. Finally, looking at the cash flow, let's close a few of these out. So let's just look at the net change. So they're down 3.86 billion in 2021, down again in 2023, 11, and then up in 2023. One thing important is the operating cash flow, which they're making day to day. So 104 in 2021, 122 in 2022, and 120. So it's pretty solid, right? You know, I wouldn't expect any less from Apple. So look, thanks a million for watching, and I'll catch you in the next one.